only mode.
Good morning, everyone. Welcome to using divergence as a leading indicator for trading binaries. My name is Gail Mercer, and I will be your hostess for the day. Now, because all trading does involve risk, I would like to make sure that everybody reads over the Nadex risk disclaimer. Basically, trading any type of financial instrument is going to have risk, and you should never trade with money you cannot afford to risk. And this applies even to Nadex binary options and spreads. They do have a limited risk on entry, but again, you can still lose money. So I want to give you just a couple of seconds to read over the disclaimer, and then we'll get started and we'll look at using divergence as a leading indicator for binaries. Good morning, Rick. Now, for those that do not know me, I have over 15 years of trading experience. I started out with a company that programmed indicators, and I really became enticed by the price bar. I just thought it was so unique that we could trade these instruments intraday. I do specialize in price action, volume analysis, and divergence because I do believe they are leading indicators. I'm also a frequent contributor for Stocks and Commodities Magazine, Traders World Magazine, and Top Shelf. I've also been a speaker at Traders Expo, Traders World Online Expo, and the Wyckoff Volume Conference. I'm also the author of Trading Nadex Binary Options, Keeping It Simple Strategies, and the New Trader's Guide to Trading Binary Options and Spreads. Now let's begin by defining what divergence is. There's basically what I call two types of divergence. One is trend divergence and one is hidden divergence. Trend divergence is when price is making higher highs, but your stochastics or any other oscillator that you want to use is making lower highs, okay? Or if you're in a downtrend and price is making lower lows, but your oscillator is making higher lows, then you have trend divergence. Hidden divergence is a little bit harder for people to see because on hidden divergence, you're actually making lower highs in price, but your oscillator will be making higher highs. Or you could be making higher lows in price and lower lows on your oscillator. Now, I like the stochastics, so all of my examples will be using the stochastics. Now, this is an example of trend divergence. You can see that price was making higher highs over here, and this was the highest point in the stochastics. Price came back to test it, and when it did, it made a lower high. This is trend divergence. Now, hidden divergence is really quite the opposite. In this case, you're making higher lows, but you're making lower lows in the stochastics. And this is real important because whenever you see this, you can expect price to go up and take out that high off of hidden divergence. The same thing over here. You make a low and then it comes back to test it. And when it does, you make a lower low on the stochastics with a higher low in price. Again, that is a great indication that this high will be exceeded. Okay? Now, how do you use divergence as a leading indicator? I combine the pattern with a 3-bar reversal. Now, in this case, you can see that price is making higher highs, but the stochastics is making lower highs. Notice that I'm reading these on the reversal bars themselves. So here you have a reversal bar, here you have a reversal bar, and that's the point where I'm reading the divergence. In other words, before the stochastics even starts to turn good, I'm usually already reading whether we have divergence or not. Now in this one, you can see that I believe it was on Monday, I actually used this on a spread in a binary. Now this was prior to the market opening, okay? And you can see that as we're making lows right in here, we're making lows, but you can see that we're going down on the stochastics. So we have higher lows, but the stochastics was making lower lows. This was a good indication that the market was going to go up. Now, I always trade a low risk method because there's always risk involved. And what I try to do is increase my reward side and lower my risk side. In this case, I actually bought the spread, and it was a daily spread, for 2,800 to 21,200. The risk on it was $28 per contract. Now price went up, forms a reversal bar here, forms trend divergence. I exit the position, and then I wait for it to come back and test this ATR. And you can see that as it did, you get hidden divergence. This is an entry using a short binary. And again, it only had $28 of risk, and then it continues down. And these are usually really good areas for these low risk binary options. Now, if you're using trend divergence, it doesn't mean, and this is a common misconception, it doesn't mean that the market will reverse. What it means is that it's going to retrace and try to find an area that is either going to support price or resist price if you're in a downtrend. Now, if that area holds, then you can anticipate a new high or a new low in the downtrend. And this is where you can really utilize these out-of-the-money binary options. This is trend divergence. You can see the magenta dot at the top of this bar. And this one clearly shows that as this was making highs, the stochastics was making lower highs. Again, this gives you trend divergence. So this is my first indication. And remember, this is trend divergence. It tells me that price is going to pull back. So once you have the trend divergence, then as price pulls back, that's when you start looking for the hidden divergence to enter a binary option. And again, I only do out-of-the-money binary options. So in this case, when price retraced back to this plus sign, which will act as an area that will support price, that's where your entry is. And again, you see that you have that 3-bar reversal right here in the center. And this bar is actually a doji that has made a low. It means more likely than not, price will go out and it will exceed the previous high, which was over here. That is exactly what I look at for a setup. And again, just use the out of the monies to actually lower your risk. Divergence does provide great opportunities for trading both binary options and spreads. Now, when do you choose a binary option versus a spread? It depends on, what kind of movement you are anticipating. If you're anticipating a large move, I would go with a spread. If you're not really sure if it's going to move a lot, I would choose a binary option. Sometimes it's as simple as looking at your risk. Sometimes you can get the binary cheaper than the spread or the spread cheaper than the binary. So you're always looking at the trade-off between the risk on a binary versus a spread and the market movement that you're anticipating. Also, always draw your lines if you really want to learn divergence. You know, I realize that a lot of times I might make something look very simple, but it's because I've studied it for a long time and my eye just will naturally pick it up. If you're learning this technique for the first time, I really do suggest that you actually draw the lines on your chart and analyze them as they're coming up. You can also combine reading the stochastics with the price action, which is a 3-bar reversal. They're also called pivot highs and pivot lows, to identify opportunities where you can lower your risk and increase your reward. When the market is moving slow, you need to buy time or use an at the money. I choose to buy time because I use out of the money binaries. I don't really like at the money. I just prefer the out of the money because I trade risk to reward. So my technique, I would buy time. If you like to do at the money, okay, then if the market is moving slow, always, try to get at the money because you do have a slower moving market. It may not be able to move the strike width if you're doing out of the money because it's just really slow. Okay, so a great example is I normally trade a 2-hour out of the money binary. Well, with the market moving as slow as it is, I'm switching over and I'm using the dailies, okay? Now, if you have any questions about anything that I presented today, you can always email me at gm@tradershelpdesk.com, or you can visit my website at tradershelpdesk.com. Does anybody have any questions this morning? Go ahead and pull this one over here. And this is one I've just been kind of watching all morning because we've had a lot of hidden divergence on this one. Here, you see you've had hidden divergence. So again, this would have been an entry. You could have used, a 2-hour binary or a daily binary. That was your hidden divergence here. Then I think that's the only one that had the hidden divergence on it. From here to here, all you're seeing is regular movement and that you're making lower highs. And this is what's considered normal behavior because you're making lower highs, but you're also making lower highs on the stochastics. So when it makes this high here, then well, it's probably going to go down because it's just doing what it's supposed to do. Are there any questions this morning, guys? Yes, divergence also works with the RSI. Let me put the RSI on here and you'll probably see the same pattern. Which type of oscillator you use is really not important. I think that's more of a personal preference. So here you have the RSI. And this one does not give you the hidden divergence that the stochastics did. Not on that one. It probably does give others. And this is a great example where, and this is really just a personal preference, where here you're getting higher highs than higher lows. But again, on the RSI, you're actually getting a lower high. So in this case, the RSI picked up the divergence from here, and the stochastics did not. But again, I think it's more of a personal preference. Which one do you understand better versus which one is best? Any other questions this morning? Okay, if there's no other questions. You could, if you wanted to, Ron. You could have both the stocks and the RSI. You know, it's just whatever you prefer on your chart, actually. You know, a lot of times we will add indicators to our chart that are actually redundant, what they're already presenting. But sometimes, like in this case, the RSI actually gave you a better sense than the stochastics did that price was going to go down. And you know, another one, y'all have seen me use the pivots before. You know, another really simplistic way to do it is put the pivot points on. You know, if you're getting divergence at a pivot line, you know, chances are that, you know, the price is going to move. And here's an example over here. Again, it's just, you know, using a very simplistic way. You see that you have reversal bars here and here. And if you look at the stochastics, you can see divergence. And if you look at the RSI, you can see divergence. You know, that's what you would really anticipate. Here, you can see that it comes right back to test that low. And the stochastics gives you a hidden divergence. The RSI really doesn't. But again, it's just whichever one you want to use. But it's an easy way to incorporate support and resistance. And I think in June, I'm actually doing a presentation on support and resistance. And it's just an easy way to incorporate, okay, where will the next price bar go? Or where do you anticipate this market to go? Any other questions, everyone? Okay, if there's no other questions, I do appreciate you attending the webinar this morning. And again, if you have any questions, then just send me an email at gm@tradershelpdesk.com.